Early 2026 saw the global economy slam to a halt. Trade routes paralyzed, supply chains choked, and a threat of stagflation loomed over markets. The physical epicenter was the Strait of Hormuz. A strict maritime blockade severed 20% of the world's seaborne oil and critical liquefied natural gas supplies overnight. The immediate effects were brutal. Middle Eastern aviation, including mega carriers like Emirates and Qatar Airways, was completely grounded. Across the Gulf states, grocery prices spiked by up to 120% as staple food imports vanished. Then came June. An unexpected interim peace deal was signed, allowing commercial vessels to finally pass safely through the strait. The physical blockade ended. Following months of deep economic anxiety, a unified wave of global relief seemed certain. Everyone anticipated a broad, euphoric recovery across the board. But that is not what happened. Traditional equities rocketed upward. The Dow Jones Industrial Average crossed 52,000 for the first time in history, pulled along by a massive surge in big tech stocks. Capital also flooded into unexpected emerging market safe havens. Foreign investors poured roughly $4.2 billion into Indian government debt in a single month, snapping up 30-year bonds at a record pace. Yet, right in the middle of this market-wide relief rally, institutional Bitcoin ETFs hemorrhaged capital, bleeding over $4 billion in June alone, their worst month on record. At the exact same time, sovereign wealth funds and central banks quietly signaled a collective shift to reduce their reliance on the US dollar. It makes no conventional sense that global peace would simultaneously trigger a stock market boom, a crypto crash, and a flight from the dollar. To understand this fracture, we have to follow the capital. This chart traces Brent crude prices. Prices spiked during the blockade, but following the peace deal, crude dropped 12%. That plunge pulled inflation expectations down with it. Markets sensed central banks finally had breathing room to hold rates steady or cut them. With the threat off the table, liquid capital flooded straight into the Magnificent Seven tech stocks. Investors heavily rewarded companies using artificial intelligence to navigate the market volatility. That same drop in oil prices drastically reduced the import costs for energy-dependent nations like India. A shrinking fiscal deficit made India's long-term government debt lucrative for foreign investors looking to lock in high yields. The relief rally bypassed high-risk digital assets entirely. The real peace dividend was absorbed by traditional equities and specific emerging markets that directly benefited from cheaper energy. Bitcoin failed its test as a geopolitical safe haven. Instead of holding the asset, institutional investors broke open their digital piggy banks, liquidating crypto positions to fund purchases in the rallying stock market. BlackRock's IBIT fund absorbed the brunt of the damage. Integrated into advisors' model portfolios, it became the primary vehicle for institutional exit. In one trade alone, a single seller dumped over $1 billion worth of shares. This diagram models the sell-off cycle. According to Citi Research, every $1 billion pulled from Bitcoin ETFs creates an automatic 3.4% price drop. Falling prices trigger panic selling, generating more outflows, trapping Bitcoin in a steep downward spiral. Wall Street's entry into the space didn't stabilize cryptocurrency. It simply chained Bitcoin's performance to the rigid requirements of traditional portfolio models and algorithmic dumping. While retail and institutional capital was sloshing between tech stocks and Bitcoin, a much larger migration was happening at the sovereign level. A survey of central banks, public pension funds, and sovereign wealth funds, entities controlling roughly $10 trillion in assets, revealed a collective intent to reduce their US dollar allocations over the coming decade. These state-level actors are diversifying into alternative reserves. They are deploying artificial intelligence tools to actively manage risk and insulate their economies from future political liabilities. This rotation by central banks represents a concrete move toward a more fragmented global financial system as sovereign states begin prioritizing political safety over dollar liquidity. The 2026 war left permanent scars on the old economy. The Gulf states experienced massive capital flight as the physical vulnerability of their infrastructure was exposed. The image of the region as an insulated economic sanctuary has dissolved. The 2026 crisis repositioned Bitcoin as a high-speed tool for institutional liquidity and forced a new risk assessment of the US dollar for sovereign entities. This conflict proved that modern wealth reallocates at algorithmic speeds, rerouting billions across borders the moment a geopolitical shock hits. To survive the next global crisis, investors and governments must abandon the static safe havens of the past. The new reality is a fluid, rapidly shifting shockwave economy, and capital will simply flow to wherever the math works best.